move today coming amid several bearish calls on the bond market, with ING forecasting the 10-year yield could rise to 5.5% by the end of the year. You've got T. Rowe out with a scenario and a call saying that there is a potential in the realm of possibilities that maybe we could even see 6% on the 10-year yield. So here to break that all down, where we're headed next, we want to bring in Lesley Falconio. She's the head of taxable fixed income strategy at UBS Global Wealth Management. Lesley, it's great to have you back here on Yahoo Finance. So we certainly are seeing a push even higher here in yields on the back of this morning's very strong jobs print. I think the next milestone that investors are closely watching is that 5% level for yields. Is that likely coming in the next couple of weeks?
Oh, you could absolutely see that 5%. I mean, that 501 was the October 2023 high. We're 25 basis points away from that. We have inflation numbers coming out next week, and still a lot of unknown in terms of policy. So seeing that 501 is definitely attainable, but we just don't believe it's sustained. And some of the reasons why we don't think it will be sustained is that when we look at what's happening, such as 10-year real yields at a 235, they're about 15 basis points below the high that we saw in October of 2.5. And at that point, I think in that over 5%, even if it is on like strong payroll like we saw today, we think risk assets, start to get a little bit nervous. So you could see 5%, you could see 5.10, but the question is whether or not it's sustainable. We just don't believe that it will be.
What level is sustainable?
Listen, we still think, look, we think growth is going to be trend down, but remain, above trend, right? So we still think growth is going to stay strong. Obviously, today's employment with, 256, it's the highest we've seen since March of 2024, and around the 48th consecutive positive number that we've seen. So the economy is strong, but we do think over time, growth will start to slow, but stay above trend. But we also believe that over time, inflation is going to come down as well, simply because our expectation is that things like owner equivalent rent will start to trend lower. So we have strength. We have, a strong economy. We just don't think you're going to, be at a 5 or 5.10, particularly since now the market is already pricing out most cuts. It's down to only one cut in 2025, later in the year in September. So the question of whether or not they're going to pause or not really isn't a question anymore. I mean, it'd be highly unlikely that they go in March, cut in March, unless you see some, true collapse in next week's inflation report or some sort of negative payroll the next couple months. So a lot of this bearishness, if you will, is priced in simply because they've taken out so many cuts.
Lesley, the market now only sees one cut here this year. Do you?
We see two, actually. We're still staying with the two. We have June and September, right? But listen, there's a lot of data from now to then. And one thing that we know, and the Fed has stated clearly, they're data dependent, right? So you're going to see a lot of shifting narrative for each number, which really just makes the interest rate market that much more volatile, and will probably continue to be volatile given there's such data dependence. So we have a rhetoric right now that the economy is very strong. They're not going to cut. 6 months from now, that narrative can completely change. So as of now, we're staying with the June and September, 25 each, so 50 basis points in 2025. But again, it's really going to depend on what the data shows.
Talk to me about what you're anticipating as we look ahead to the next 4 years under the Trump administration. We know that Trump's Treasury has talked about shifting away from shorter-term borrowing. How do you anticipate that impacting the yield curve?
I think that's a great point, because when you look at, supply, supply is really more of a 2026 issue, right? I mean, it's not so much a 2025 issue, but to your point, what the market will be paying attention to in 2025 is the composition of that supply, meaning that, whether or not they choose to take those bills that have been used to fund the deficit and lock them up, right? So you extend out 5, you extend out to 10 years, and that composition change could have an impact on Treasury yields. But I think that's one of the reasons why that we have this rising term premium, why the yield curve is steepening, because investors are looking for compensation for that potential. But, we really don't know, or really don't see a lot of supply, or is increase in supply a concern until that 2026 sort of time frame. But even listen, a lot is going to get to be seen in terms of what they could actually get passed through, particularly when it comes to further tax cuts outside of just the extension. But that's going to be, I think, an end of the year type of issue into 26. What's not is how that composition works and whether or not they take those bills that are rolling off and lock them in a little longer. But I think that you're getting compensated for that now, and that's why the term premium has been rising so much.
All right, Lesley, thanks so much for joining us.
Thank you.